Hello everyone, welcome back to Fundrise Finance. Just when everyone thought that the entire stock market was getting into a good rally mode starting mid-June all the way till mid of August, where we saw a rise of almost 18% in the S&P 500 in just 2 months. After a drop of almost 24% in the first 6 months of the year, the summer rally seemed a good, happy move. But what we see since mid of August till today, that's end of August, is not such a good happy picture. We see a drop of more than 8% in just 2 weeks. Most of the recent losses can be attributed to the speech by Fed Chair Jerome Powell last Friday, after which the entire stock market seemed to have just lost its wheels. We see a dip of almost 6% in the last week itself. But should these wild moves in the market deter anybody from investing? An ideal answer would be no. To be frank, when I saw the markets rising up and up for almost over 2 months, I felt we were losing a good chance of buying quality stocks at very good valuations. But this recent dip is giving us those opportunities back, and I feel happy to invest into such falling market. In today's video, I would like to go over five such stocks which provide a very good buying opportunity at the moment. But before jumping into that, let's look at our dividend picks for the month of August, how they have done. So last month, we had BlackRock, Medical Properties Trust, Medtronic, Starbucks, and Morgan Stanley. Among these, Morgan Stanley has been the best performer in the last month, returning just over 1%. The worst has been Medical Properties, down more than 15%. Medtronic, the next worst performer, just under 5% loss for the last month. After that, we have Starbucks, down less than a percent, and BlackRock, just almost half a percent loss in the last 1 month. I have one stock among these which I have considered even for the September list. Now, what is that? Please check out the rest of the video. Now, without any further delay, let's jump into the stock picks for the month of September. The first stock on our list is JP Morgan Chase and Company, ticker symbol JPM. JP Morgan Chase is a financial services company that operates worldwide. It offers banking and asset and wealth management services. Year to date, we see JP Morgan falling almost 30%. The last 1 year, similarly down 29%. Last 5 years, it has returned a positive 24%. There's a market cap of $335.52 billion and currently yields 3.5% with a forward PE of 10.2. From a dividends perspective, JP Morgan has been raising its dividends for the last 7 years at a 5 year dividend growth rate of 15.33%, which is really good. It's much better than the current inflation. So all the dividends that we get out of this company will not lose their value to inflation. And the payout ratio is very good at 32.6%. Morningstar considers JP Morgan Chase a 4-star stock and gives it a fair value of $149. Value Line gives JP Morgan a financial strength of A plus and has a midpoint price target of $151. As per my own calculations, which considers the current and historical dividend yields, I consider JP Morgan to have a fair value of $136.92. Averaging all these three values, we get a fair value of $145.64, which makes JP Morgan undervalued by 28.06%. The next stock on our list is Whirlpool Corporation, ticker symbol WHR. Whirlpool manufactures and markets home appliance products. It has multiple brands under its portfolio with its own namesake Whirlpool. You have KitchenAid, Maytag, Jenna, and also a few brands such as Brastemp and Consul, which it operates in Latin America, and Hotpoint that runs in Europe and Middle East. Year-to-date, Whirlpool has fallen almost 33%. In the last 1 year, it has returned a negative 29.3%. It has a market cap of $8.6 billion and currently yields 4.44% at a forward PE of 6.93. From dividends perspective, Whirlpool has been raising its dividends for the last 11 years at a 5 year growth rate of 9.63%. So that's on par with the current inflation rate. It has a very low payout ratio of 26.14%. Morningstar considers Whirlpool a 5-star stock with a fair value of $215.36. Valueline gives Whirlpool a financial strength of A and has a midpoint target price of $220. As per my own calculations, I found Whirlpool to have a fair value of $202.14. Averaging these three values, we get a fair value of $212.50, which makes Whirlpool undervalued by 35.69%. The third stock on our list is Citigroup Inc., ticker symbol C. Citigroup provides various financial services to consumers worldwide. Year to date, we see Citigroup falling almost 23%. In the last 1 year, it has fallen just over 32%. It has a market cap of $95.05 billion and currently yields 4.16% at a forward PE of 6.69. Seeking Alpha shows Citigroup to have a consecutive dividend growth of 0 years. It has a 5-year dividend growth rate of 20.59%. It is more than double the current inflation and a very low payout ratio of 25.73%. Morningstar considers Citigroup to be a 5-star stock with a fair value of $78. Value Line gives Citigroup a financial strength of B plus and has a midpoint target price of $62. As for my calculations, I found Citigroup to have a fair value of $60.13. Averaging these three values, we get a fair value of $66.71, which makes Citigroup undervalued by 36.67%. The fourth stock on our list is Medtronic PLC, ticker symbol MDT, which is from the healthcare sector. Medtronic develops, manufactures, and sells medical equipment to clinics and hospitals worldwide. Year to date, we see Medtronic falling more than 17%. The last 1 year, it has fallen more than 34%. The last 5 years, we see a positive return of almost 10%. It has a market cap of $116.01 billion and currently yields 3.12% at a forward PE of 15.83. Signal Alpha shows Medtronic to have a consecutive dividend growth of 5 years at a 5-year growth rate of 7.99% and a payout ratio of 35.39%. I don't think this 5 years value is correct because to my knowledge, Medtronic is a dividend aristocrat. Morningstar considers Medtronic to be a 4-star stock with a fair value of $129. Value Line gives Medtronic a financial strength of A++ and has a midpoint price target of $118. As to my calculations, I found Medtronic to have a fair value of $115.02. Averaging these three values out, we get a fair value of $120.67. That makes Medtronic to be undervalued by 37.25%. The fifth and final stock in our list is Comcast Corporation, ticker symbol CMCSA. Comcast operates as a media and technology company worldwide. When you look at the company's brand, we have Xfinity, that is its internet services, NBC Universal, and Sky, which operate the television landscape. Other than these, Comcast, or in fact, I should say Universal, also operates theme parks worldwide. So we see that as part of the NBC Universal, where it runs film studios and also theme parks and resorts. Year to date, we see Comcast falling almost 29%. Last 1 year, just over 40% in the negative side. It has a market cap of $157.64 billion and currently yields 3.02% at a forward PE of 10.06. From dividends perspective, Comcast has been raising its dividends for the last 4 years with a 5-year growth rate of 12% and a payout ratio of 29.63%. Morningstar considers Comcast a 5-star stock with a fair value of $60. Value Line gives Comcast a financial strength of A plus and has a midpoint target price of $52. As for my calculations, I found Comcast to have a fair value of $48.37. Averaging these three out, we get a fair value of $53.46, which makes Comcast undervalued by a whopping 47.71%. So these are the five stocks which we just discussed. To summarize, we have Citigroup, Comcast Corporation, JP Morgan Chase, Medtronic, and Whirlpool. The recent downtrend in the markets have brought all these stocks into a very good buy point. As we just saw, they're undervalued anywhere between 28% to 48%. So I personally feel we should make use of this opportunity and invest into such stocks. That's all I have for this video. Hope you liked it, and I would really appreciate if you could hit that like and subscribe button, which would help YouTube suggest this video to many more out there. Until we meet in the next video, let's try to do as much as possible to be financially healthy. See ya. Bye.